Options trading has so many different moving parts and it can get a little bit confusing, but once you understand them and if you can play your cards right, you can start multiplying your returns. Let's talk about it. Hi y'all, my name is Greg and I make videos about the stock market and options trading. Today, we're going to be talking about regular options, calls, and puts. So to break this video down for you, first we're going to go over the basics, then I'm going to show you some real examples using Robinhood, and finally at the end of this video, we're going to go over the risks associated with options trading. You'll definitely want to stick around to the end for this. But before we get into it, if you enjoyed this type of video and you want me to make more option tutorials, make sure to let me know by leaving a like down below and subscribe if you're new to the channel. With that out of the way, let's talk about options. There are two types of basic options. You have the call option and the put option. In a layman's terms, you'll buy a call option when you think the stock price is going to go up. You'll buy a put option when you think the stock price is going to come down. But it's a little bit more nuanced than that, because not only do you have to choose whether the stock is going to go up or down, you also have to choose an expiration date. And sometimes there can be so many to choose from. For example, with SPY, they have 3 weekly options, whereas most stocks either have weekly or monthly options, and you can even buy yearly expiration dates. So which one do you choose? Well, the expiration date that you choose really depends on how quickly you think the stock is going to move and how long you plan to hold your option for, because the longer you hold your option and the closer your option comes to its expiration date, the more and more value your option is going to lose based on time decay. This is why if you buy a weekly option and the stock doesn't move at all, your option is still going to lose value, whereas if you're to buy a Leaps call with a 1-year expiration date, that option isn't going to lose nearly as much of its value. But there's even more to it than just your expiration date and whether you think the stock is going to go up or down, because you also have to choose a strike price, and this is probably one of the hardest parts of choosing your option, but it doesn't have to be. You see, whenever you choose your strike price, you're signing an agreement at that price. With a call option, you're agreeing to buy 100 shares at your strike price, and with a put option, you're agreeing to sell 100 shares at your strike price. This means if you think that XYZ stock is going to be above $100, you're going to buy a call option with a $100 strike price, and if you think XYZ is going to be below $100, you're going to buy a put option with that same $100 strike price. And when it comes to your expiration date, that option will either expire completely worthless, or you'll have the right to actually execute on your option to buy or sell 100 shares at your strike price. Using our $100 call example from earlier, where we were agreeing to buy 100 shares of XYZ at $100, if XYZ was trading at $90, would you still want to buy those 100 shares? Probably not, because you can get them $10 cheaper at the market price. So this option makes 0 sense, and it's going to expire out of the money or completely worthless. The opposite goes for a $100 put option on XYZ, where we are agreeing to sell 100 shares at $100. If XYZ was trading at $110, you would never want to sell your shares at $100. So that option is completely worthless. So this is generally how you would choose your strike price, but not always, because most people don't actually hold their options until its expiration date. As we talked about earlier, as your expiration date comes closer and closer, the more value your option is going to lose based on time decay, and once 8 p.m. hits on your expiration date, that time value is completely gone. So with this in mind, you'll always want to sell your option before it expires to capitalize on that extrinsic time value. So this means that you don't have to choose your option based on what you think the stock price is going to be at your expiration date. Instead, you could choose it based on how much money you have to spend, but keep in mind here again that your option can expire completely worthless. So don't put down more than you're willing to lose on any option. Now that we covered the basics with call options and put options, expiration dates, and strike prices, let's move on to some real examples. The first example that I want to take you through is an option that I already have open, and this is the call option on AMD. My strike price is $72.50, and my expiration date is July of 2022. Right now, we're in May of 2021, so I have over a year until this option expires. I made sure to give myself enough time for this option to expire in the money, and for this, I had to pay a pretty penny. The cost of this option was $1,945, and right now this is going for $1,455. So if I were to buy another one, this will cost me $1,455 in premium. Or if I wanted to sell this option, I could sell it for $1,455. But of course, I'm not going to sell it because I think that AMD stock is undervalued. I think it's going to go up. So I'm going to keep holding on to this. If I'm right about this and AMD reaches my $150 price target, which is completely separate from my strike price, which is $72.50, this option would have $7,750 worth of intrinsic value. Intrinsic value can be calculated by taking the difference between the current share price and the strike price for an in-the-money option. And that $7,750 is discounting all of the extrinsic time value that would be left in this option if it reached my $150 price target before its expiration date. Because you see, there's two types of value in an option. You have intrinsic value, which we already defined, and then you have extrinsic value or time value. Now, this is made up by the Greeks, and I made an entire video on that. You can check it out in the top right corner. But anyway, getting back to my AMD call, if AMD reached my $150 price target, this option is going to have $7,750 of intrinsic value on top of any extrinsic value left in the option. And remember, I paid $1,945 for this option, so at minimum, if AMD reached my price target, I would be taking $5,805 of profit, or more than 3 times my initial investment. In the meantime, AMD stock would only need to double in order to reach my $150 price target. And this is what you call leverage, and this is the entire point of options trading. But that's enough about my own holdings. Let's go through some new examples. A good stock that pretty much always goes up is Apple. It goes up more often than it goes down, so we're gonna bet towards the upside and say that Apple stock is going to go up. So for this, we're going to buy a call option. Of course, we're going to set our expiration date for June 18th, give ourselves a month till expiration. You can choose your expiration date however you like, but I'm just going to choose June 18th for this example. So we're going to scroll down the option chain, and I think a good option to buy right now would be the 122.50 call option. That's going for $523 of premium. So we would pay $523 to open this trade. And if we're wrong about Apple and it's below $122.50 by our expiration date, we're going to be losing that $523. But if we're right about this and it's above $122.50, we might be making a profit. When it comes to options, you also have to calculate your break-even price, which can be taken for a call option by adding the $523 that we're paying for this option to the $122.50 strike price, giving us a break-even of $127.73. So anything above $127.73, we're going to be making a profit. Anything below $127.73, we're going to be taking a loss. But this is only when it comes to the expiration date. If, say, Apple goes up in the next couple of days to $130, we're probably going to be making a lot of profit on this trade. If you ever want to calculate how much profit you can make, you can always go to optionprofitcalculator.com or download the mobile app. And from here, you can see how much money you would make at each different price on any day before the expiration date. So if Apple had some huge news come out over the weekend and it flew up to $130 on Monday this week, this option could gain $273 of value and net you 52.5% profit if you sold it then and there. And you'll notice as time passes and we stay at this $130 price target, our profits are starting to diminish. And this is what you call time decay. This applies to put options as well, which is our next example. A good example for a stock that's pretty much always trending down like a truck rolling down a hill is Nikola. So we're going to choose put options, and we're going to give ourselves a little bit more time for this option to expire because Nikola is sort of a slow burn. It doesn't like to lose its value very quickly, but over time it continues to trend down. So we're going to set our expiration date for July 16th, and we're going to try to choose a reasonable strike price. I think there's a good chance that Nikola stock will be below $10 by our expiration date, so we're going to choose this option right here. And for this, we would pay $87 in premium. And the break even for this actually pretty much aligns with the all-time low for Nikola stock. So if it continues to trend down over the next couple of months, we will be making a profit on this. Our break even can be calculated by taking the difference between the strike price and the premium we're paying, which would be 10 minus 87, giving us a break even of $9.13. So if Nikola is below 913 by our expiration, we'll be taking a profit. And if it's above 913, we'll be taking a loss. And if Nikola somehow manages to stay above $10 by our expiration date, this option is going to expire completely worthless, and we're going to lose the $87 that we put into this trade. Ideally, we would want Nikola stock to drop pretty quick. That way we can capitalize on the extrinsic time value before this option expires. If Nikola stock were to drop to $10 by tomorrow, we'd be taking 74.7% profit or $65 worth. But you'll see as time goes on, we'll lose that extrinsic time value. But if somehow Nikola stock were to drop to, say, $6, which, I mean, that's pretty unlikely, that's a drop of 50%, we'd be taking 360% profit or $313 off an $87 investment. Again, very unlikely, but anything is possible with Nikola. And that just about wraps up all the examples, but you'll want to stick around for what are the risks of options trading. By far the biggest risk when it comes to options trading is having your option expire completely worthless. And I guess you can really say the same thing about stocks because any stock can go to zero, but there's a much higher likelihood of your option expiring completely worthless a lot faster than a stock going to zero. So this means whether you put $100 or $10,000 into options, your option can expire completely worthless and you'll lose everything that you put into it. You can stack the odds in your favor as much as you want by setting your expiration date a year out, choosing a super deep in the money option, but If you're wrong about your investment, the option could still expire out of the money and you would lose everything you put in. So this is why I always stress never put in more than you're willing to lose, especially when it comes to options trading. And the next risk really goes hand in hand with this. Even though you can multiply your returns, you can also multiply your losses if you're wrong about the direction on a stock. If you buy a Leaps call option with a really high delta, for every dollar the stock moves down, your option is going to lose by that amount of delta. So if you have a 0.9 delta, for every dollar the stock loses, you're going to be losing $90 on your option. If the stock goes down significantly from when you bought it, you might be down 50% on your option or even more. Right now on my AMD call, I'm down by 25%, even though the stock is only down by 7% from when I first bought it. I'm fine with this though, and I'm willing to hold even in the red because I'm convinced of my $150 price target. That being said, I'm putting $1,945 down, and I'm willing to lose that if I'm wrong about this. In my eyes, there's much more upside than downside on this trade, and I like my odds. Otherwise, I wouldn't have bought it. That's pretty much it on options though. If you have any questions, leave them down in the comments below. And before I go, I want to say thank you to all my patrons for the support. So much appreciated. And if you will enjoy my Patreon for live trade alerts, one-on-one consulting, and so much more, make sure to check it out down in the pinned comment below. Thanks for making it all the way to the end of this video. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye guys.